Hello, my fellow Extraordinary Americans. I'm Cosmos Dar, and this is Extraordinary America. What is Extraordinary America about? You see, American identity is about freedom, the opportunity for a better life, and the pursuit of happiness. Welcome to Extraordinary America. For today's guest, we have Lane Kawaoka. Lane is an entrepreneur, investor, two times best-selling author, ex-engineer, and owner of more than 10,000 rental units. Lane's expertise in guiding high net worth professionals through wealth building in real estate investments aligns perfectly with Extraordinary America's focus on freedom, entrepreneurship, and business. Lane has raised over $200 million to purchase and control over $2.1 billion of apartments, mobile home parks, self storage, hotels, and other commercial real estate assets. Most importantly, he distributed over $45 million back to his passive investors. As an entrepreneur who transitioned from engineering to owning over 10,000 rental units, Lane embodies financial freedom through innovative strategies like infinite banking and advanced tax planning. His mission is to divert investments from Wall Street to tangible Main Street assets, resonates with the theme of American entrepreneurship. His insights on building passive income streams and strategic asset management offers valuable knowledge to people aspiring for financial independence. He has written the books The Wealth Elevator and The Journey to Simple Passive Cash Flow. He's a member of Forbes Real Estate Council, Fast Company Executive Board, Vistage, and Entrepreneurs Organization, and has made guest appearances on Money Ripples, The Land Geek, Bigger Pockets, Wealth Formula, and Cash Flow Ninja. Lane is an extraordinary American, and I'm honored to have him on the show. Lane, are you there?
Hey, thanks for having me, Cosmos. Aloha, everybody.
Lane, thank you so much for taking the time to do this podcast with us. Could you tell me and the audience a little bit more about yourself, your background, and how you got started and your story in general?
Yeah, I think, it started off, got brought up in like a middle class family. We're taught to go to school, study hard, go to college. I eventually, became an engineer. That's what I went to school for, started to work. And then, even up until that point, kind of brainwashed to do the old traditional 401ks. Also buy a house to live in, which I did shortly after graduating. But it all kind of changed when I just started to rent out my home and got this taste of cash flow and realized like, wow, my tenant's paying down my mortgage. I'm getting these tax benefits and, making a little cash flow every month. In fact, in the beginning, it was, a few $100 at least per month, good beer money back then for a 20-year-old kid. And that was kind of how it all started. And then a few months went by and I was like, wait a minute, if I kept doing this, I'll be able to, quit my day job. And that was kind of where it all started back in 2009, about that first rental property.
Wow, Lane. Like normally, most people they just go to college and they just get a job and then they go through life. But you went from there to where you are today. Can you tell me and the audience a little bit more about your strategic vision and your goal, starting from college to like where you are right now and how it evolved over a period of time?
Yeah, initially it was very simple, right? Put the rental property into, rent it out and make, a few $100 per month of cash flow. But then I started to realize like, wow, if I bought in other places, at that time it was in Seattle, Washington, which is what's known as a primary market. So primary markets are, really cool places to live, like Hawaii, San Francisco, pretty much all of California. And they don't have the best rent to value ratios. So rent to value ratios are you take the monthly rental price divided by the purchase price, and you're looking for something that's 1% or higher so that you can cash flow with bigger margins. Places like California or Hawaii, you'll be lucky to find things that are 0.5%. But, after that first few units in Seattle, Washington, I started to catch on to the fact that I could buy properties in places like Birmingham, Atlanta, Indianapolis, that were more what we call our secondary and tertiary markets, less sexy places essentially,
Mhm.
where the numbers are a lot better in terms of rent to value ratios. And that was kind of, where my, after the first few units in Seattle, I sold those and I kind of had 11 rentals in 2015 in these various markets. And all the while, like, doing this completely remote, right? Had property managers remotely and still working my engineering job when I was up in Seattle full time.
Well, so Lane, one question I wanted to ask for the sake of the audience is, so you were an engineer and then you started this on the side, right, where you started doing rental units. So my question is, how did you scale from the first rental unit to 10 to about 10,000 rental units? Like, what is your process and strategy, and how did you go about doing that?
Yeah, I mean the first 11 I had a property manager in each location. So I think I had like five in Atlanta, four in Birmingham, another in Indy. So I had a property manager in those locations. And the way it works in rental real estate, you pay your property manager about 10%. Sometimes the first full month's rent or half of the first month's rent. That's their fee. Some people are kind of cheap and they don't want to pay it. To me, I mean, it's well worth it. It allows you to scale. But this was around 2015, and like as I write in my new book, The Wealth Elevator, there's different stages to wealth building. My first, when I was under $1 million net worth, these rental properties were great. And if you're under $1 million, especially under $500,000, you got to buy rental properties. You got to go through these growing pains. At that point for me, as is becoming more of an accredited investor, these 11 rental properties were becoming a bit of a chore because, what's it like to own 11 rental properties? Well, the tenants, they're not the most reliable. They maybe had an eviction or two every single year and some kind of big catastrophe or issue that happened, like a tree fall on the house or, flood out in the basement or something on one of the rentals. Um, which is, not the hardest thing. I mean, it's not that out of hand, right, with 11 rentals at that exception rate, but at a few $100s of cash flow per property, times 11, that's about a few $1,000s of cash flow per month.
Mhm.
You know, can be grateful for that, right? It's great. Certainly is amazing when I first started, but most of my clients today are looking for ten to $15,000 of passive cash flow a month. So those 11 rentals aren't going to cut it, right? You're going to need like 30 or 40 of these things. So you also have to multiply that exception rate, the headaches, by three or four. And that was kind of where in 2015, 16, I was like, this is not scalable. And I started to search for what is it that accredited investors do after rental properties. So there was a bit of a pivot at that point.
Well, just as a continuation of that, like, what was like the change in thinking or the pivot that led you to do the actions that led to scaling?
So I started to invest in larger deals. Started to realize a lot of this is just interacting with purely passive accredited investors. People who had owned rental properties, but their networks had grown, and they also, as sort of data points on their own, found the world of syndications and private placements. So if you haven't heard what these things are, think of it like kind of a country club deal. Right?
Hmm.
You are in the network of people doing these larger deals, buying, large institutional assets such as apartments. Instead of buying one or four units at a time, you're buying 100 or 300 units. And it started to realize, wow, this is a thing. Definitely not what people are talking about out there, right? Which is why it's important to, network. But again, like there's stages to this wealth building journey. If you're $1 million net worth or less, all this information I'm telling you is great. You can check it out in my book, The Wealth Elevator, but it's not really applicable to where you are in the journey at this point, right? Like it took
Hmm.
me from 2009 to 2015, 16 to kind of get to this point, all the while plowing, at my day job, I was able to save 50 to $100,000 a year to put the down payments to buying more and more real estate in those years. So it took a while to mature. But that was, started to realize like people were trading in their little rental properties for these larger placements as an investor in these larger deals. And definitely was kind of a way of, getting, a lot more scalability in investing in this method.
So, Lane, one of the things that is admirable of you is that you're a self-made person. Like you went from a middle class background to where you are today. So, my question for the sake of the audience is, how did your mindset around money evolve as you went from less than $1 million net worth to multi-millions and all of that? And what is the thought process and the evolution? Because it required a lot of self growth in order to be able to handle all of that, right?
Yeah, I mean, I think, and I still know a lot of people like this who were kind of on my trajectory and they just went and bought 20 rentals and 30 and 40 rentals. Um, Part of the difference was the legal liability. When you own rental properties directly, you're on the front line to getting sued. Frivolous lawsuits, somebody slips, trips, or falls, they're gonna sue you. So this was, you start to interact with higher net worth people, they're more concerned about losing their money than making money, right? Like people who don't have very much money, they don't really have much to lose, and they're more interested in making a lot of money. But once you have money, it kind of flip-flops in a way. So, that was one mindset shift that happened. And then also the scalability. Certainly, and it's still present for me today. I'm a part of what got me here in the early days was just being really frugal with my money. That's how I saved up the first 20, 30 grand for the first rental property. And bought the next property and the next property. So that's kind of what I call in my book, The Wealth Elevator, the basement floor. But unfortunately, like a lot of people just don't have this in their pedigree, right? Don't spend money when you don't have it. Don't buy a soft drink when you're at a restaurant. Drink some water, buddy.
Mhm.
Um, you do that enough, and if you have a good paying job and you're able to save $5,000, $10,000 a year, you can go buy a rental property in a short amount of time. I guess if you call a year or a few years a short amount of time, but that'll get you on the escalator of building wealth, much more than just buying your own primary residence. But after a while, you start to the years pile on, and you start to get that hockey stick. That's when you have to have these, you have to make an effort more for scalability because and again, this is the gradual part, and it's somewhat esoteric, but time is more valuable than money once you hit a certain point. I'm not going to say it's different for everybody, but maybe 500,000 net worth. Some people until they hit $2 million net worth, they kind of finally get it, right? But that's kind of a more of the mindset shift change.
No, totally. Time is very valuable, and you can never get back time. Like money, you can lose and you can get it back, but time you can never get it back. But Elaine, one of the questions I wanted to ask was regarding like real estate and just well building in general. What is the biggest lesson or revelation you had during your career about this industry and also like building wealth?
Yeah, I mean, essentially at the end of the day, you're just trying to buy assets that produce income or grow, right? I could care less if it's real estate, right? But I think the reason why myself and a lot of people choose real estate is there's a few other benefits, one of which is the taxes, right? When you have real estate, you can take a paper loss off of the building improvement value, offsetting a lot of the income that you're making. And when you get into larger deals that do cost segregations and take advantage of more aggressive commercial real estate depreciation schedules and bonus depreciation, the tax benefits can be even more powerful. So it's another concept. It's not much how much money you make, it's how much money you keep, right? Like if I make 100 grand through crypto and I pay half of it in taxes because crypto is not really shielded by any taxes because there's no paper loss there. At the end of the day, I made 50 grand. But if
Mhm.
my real estate made me 100 grand and I was able to shield it 100% with taxes, with these losses on paper, then I made 100 grand, you know, doubled up what the crypto did, right?
No, totally. So Lane, as a continuation of like, since we're talking about taxes, what according to you, what is the one tax mitigation strategy that the wealthy would know of and understand that the middle class are not aware of?
It's using real estate losses to offset other passive income you have. What you pay in taxes is not really dictated by how much money you have, your net worth. It's all what your income is that year. And if you guys GPT what is adjusted gross income or AGI, there's every year there's a AGI schedule like chart that says how much you pay in taxes per the US progressive tax program. So if you're able to drive your adjusted income down, one of the strategies that we use is invest in real estate that allows us to offset or neutralize our income, which in turn lowers our income, our HEI, which obviously in turns we pay less taxes. We have less taxable income. So I'm not a CPA, I'm not a tax attorney. If people need a referral to a good one, maybe reach out. But hey, this is what's worked for me in the past, and there's very quietly a lot of people doing this, right? Wealth whispers, you know.
Yeah, I mean, like understanding tax strategies at a certain level, like it is vitally important, because normally when you have people of the middle class, like they just see everything differently, versus where the wealthy and the rich see it, it's just like a different mindset altogether around the same thing.
Yeah, I mean, I see it all the time. It's kind of funny, you know. I mean, I guess nobody really believes what they see in the media, right? But the media will always say like, "Oh, the rich are, they're gonna pay the billion-dollar tax or billionaire tax or whatever." Like that's not how taxes work. Doesn't matter if you're a billionaire. It's what your income is that particular year, essentially.
So, so Lane, I had one question. Normally, a lot of people in the middle class they view inflation and debt in a certain way. But from your perspective, how do you view inflation and how do you view debt? Do you see debt as a strategy to acquire assets, or like what is your opinion on that?
Yeah, that's a double-edged sword. It can hurt you and it can help you. And essentially the way I look at it is debt is kind of like a magnifier. Makes good deals better, makes bad deals worse. You never, figure out what's happening in the market. So that's what creates this element of risk. But for people who are able to diversify, through the time lengths of markets, right? Different, in kind of dollar cost average in a way, you're able to somewhat, take out the chance of, you investing in the one or two bad years. Like for example, commercial real estate went down very heavily, 20 to 30% in 2021 to 2023. That was kind of the peak of the market. Um, but if you were diversified longer than that, you would have been fine. And by that delta with the leverage, right, or debt, right? So people use debt because with commercial real estate or real estate in general, even rental properties, banks love it, right? Because it's a hard, tangible asset. The business of like renting this out to people isn't really going to change, right? It's not like a tech startup or anything like that. So it's very bankable by banks to lend money. The other thing is like, it also magnifies your tax benefits, right? Allows you with the same dollar to go buy maybe 4 or 5 times the amount of real estate to get 4 times the amount of tax benefits along with it. But I think, overall, like the tax benefits, I think is a big thing there. Um, I think the other thing that you mentioned as other than debt, right, is what was the other thing other than debt you mentioned?
Inflation.
Yeah, so inflation increase, the way to think about inflation, if you're an investor and you own assets such as real estate, for example, inflation is your friend. Inflation is kind of the poor man's tax because the poor man doesn't have any assets and he gets kind of screwed because, basic necessities go up in costs, but his assets don't go up. So when inflation is high, it kind of helps us, right? Because rents go up, the prices of properties go up. So that's kind of one of those insidious things that's I think a little unfortunate. So like I think I'm not a big conspiracy theorist, but in a way it is like, people are like, well, it's the wealth transfer, right? It's the rich getting richer. Right? Well, you understand the game. The rich buy assets with or without debt, but they buy assets so that it can go up with the pace of inflation and they can keep up with the pace of inflation. That's how the world works. That's how the game works. Play the game.
Lane, I'm so glad that you're mentioning this because a lot of people need to know how the rich view like inflation and also debt. So one of the things I learned during my time is that debt, there's consumer debt and then there's strategic debt, where like you acquire, where you get debt to acquire assets, which increase in value over a period of time. And that was a game changer. That was like a shift and mental shift for me. But normally when people think of debt, they think of it as a negative thing. But for the rich, it can actually be an asset, and it's actually a good thing. So that's something that I
Yeah.
want to mention.
Yeah, the devil's in the details, right? Unfortunately, people don't really go much past a 1 minute YouTube short or TikTok in terms of knowledge, right? Like we do infinite banking policies as one of our strategies, and it uses whole life insurance. Well, use whole life insurance with very high commissions, and it's pretty much a scam. Or you can configure it the right way with very low insurance and low commissions. Still whole life insurance, right? But you got to dive in the details. Same thing with debt. You can have really crappy consumer debt where you go to the money tree store or you get 20, 30% credit card interest rates to go buy some, thing you don't need. Or you can get 5, 6% debt to go buy a commercial property that puts money in your pocket. Both are debt, but the devil's in kind of the nuances, right?
Hmm. Lane, you mentioned about infinite banking. Can you tell the audience a little bit more about what infinite banking is so that they can get a general idea of what that is?
Yeah, I'd say it's more for people who have a net worth of 1 million or greater. But essentially, what you're using is there's a little loophole with life insurance where it doesn't really get taxed, and people use it as a way of they buy an asset, which in this case is a life insurance contract, and they overfund it and they throw money into the policy for it to kind of be their own bank. And this is if people have heard the term be your own bank, you're essentially kind of like, being your own bank and privatizing your own bank there while making a nice safe yield there and getting the tax advantages of that. It's kind of a confuses a lot of people. It can be overcomplicated, but I would say if your net worth is under 500,000, don't even worry about it. Focus on buying a rental property first. And that's kind of what I talk about in my new book, right? Like I learned all these cool strategies from all these wealthy people, credited, people between $1 to $10 million net worth back in 2016, 20, and 20. And I was like, wow, these are really easy strategies, right? Obviously very different than what we're all taught by our parents or society. And but what I realize is like, well, at when do you implement these strategies, right? Like I mentioned, the infinite banking, don't even mess with it until your net worth goes over 1 million. Or people kind of get duped into these like real estate education programs, right? Buy big apartments, right? I mean, that's what we do today, right? We syndicate large deals, but if your net worth is under 250,000 or even under $1 million, that's not where you're at. So in my book, I have these kind of floors of the wealth building journey. And, I'm not a financial planner, you know, I'm not, I mean, certified financial planners are just guys who sell you the commission products, right?
Mhm.
That's in the traditional investment world, how it works. But these are just my own experience shares of going through this process on my own of a guy who was kind of duped into the traditional investments, the 401ks, Roths, all this stuff that we thought we were supposed to do, buying a house to live in, but then slowly discovering, what did the really wealthy do? And then what do you know? So kind of in the book, I kind of break these stages, these paradigms in the different floors. And depending on where you're at, there's a different strategy that you should be doing at that time.
So, Lane, let's say like somebody wants to follow in your footsteps, right? They just graduated from college and then they want to do real estate investing and they want to do rental properties. What advice would you have for somebody that wants to do that, and should they go about doing it?
Well, I mean, check out my book to kind of get the high level and make sure that they truly are on that. We call it the first floor of the wealth elevator. So the idea is go buy rental properties, right? Until your net worth is 500,000 to 1 million net worth. If that's the case, go to thewealthelevator.com/turnkey. We give away all that information for free that some people will charge 20 grand for. Start to learn the numbers. We have like a spreadsheet analyzer on how to underwrite little rental properties. Start there and just start buying stuff, and growing your net worth. So that's kind of the first step.
Totally. I was going to actually ask you about the wealth elevator in a little bit, but before that, I wanted to actually get your opinion on it. Like, you know that America is the land of the free and the place where dreams are made. Like, do you agree or disagree with that?
Yeah, sure. But it is hard for people getting started. That's for sure. I mean, when I first bought rental properties, I was buying, in Birmingham, Atlanta. I was buying it for maybe 70, 80 grand per unit, and it was renting for $900. Nowadays, that same property would be you pay 130,000 and it would rent for 1,000. So the numbers are just getting harder and harder to come by. Just like I guess they say that about college, right? College is getting so much more expensive and supposedly less effective at getting a good job at the end.
Yeah.
Unfortunately, that's the slippery slope, right? I mean, sure, America is the land of the free, probably has a lot more opportunity than other more oppressive countries out there, but it's getting harder. I mean, it's hard.
From your perspective, what is the biggest hurdle that Americans have when it comes to attaining the American dream, or like just being financially free and like, like living in that ultimate mansion and all of that stuff?
I mean, you hear it a lot in our circles. The hardest part is that first $100,000 of net worth, right? To do that, you obviously have to demonstrate personal finance skills, keep a freaking budget, not spend more than you make. And maybe if I were to break that down even more, it's maybe just saving $5,000 a year, $500 a month. If you're not to that point, I'm probably not the person, don't read my book, right? Like I'm not the person to follow. That there's a lot of other information out there for people like that, like Stuzy Warman, Dave Ramsey, the plethora of personal finance blogs who are telling you to not have your $5 latte every day, stay away from consumer credit card debt, obviously. But, you know, the people who I kind of work with and where I started myself is, people who are really frugal with their money. They have a good paying job and they're able to save, most of our, I mean, most of our younger clients, save 20, 50 grand per year from their paycheck. And then they can get on the escalator wealth building and, starting to buy assets such as real estate that have great tax benefits. But this is not the get rich quick scheme. I mean, look what I did. I mean, I bought my first rental 2009. It took me 6, 7 years to get to double digits in properties.
No, totally. Of course, it's not. There's nothing such as a get rich quick scheme. Like you have to do the work and you have to be smart at it as well,
Yeah. Well, there is, but it's gambling, right? Crypto, altcoins. I mean, I don't know if you consider like doing e-commerce businesses. I mean, to me, the only way you make money with that is selling other people programs to do that type of stuff. But if it was easy, then everybody would be doing it.
No, I didn't have gambling in mind. I was just thinking about like business the proper way, investing and all of that. Yeah. But speaking of that, Lane, can you tell me and the audience a little bit more about the Wealth Elevator, the book that you wrote, and the premise of how you got started and what it's about?
Yeah, it's just, I mean, what I started to realize, I started to look backwards, all the steps that I went through. There was certainly defined paradigms that I went through and kind of used this like metaphorical construct of scaling a building, right? You have different floors to this building. And what I've tried to do is, talk about the strategies and best practices or the cheat code, right? The elevator, getting you quickly from one floor to the other as quickly as possible. You're still going to have to scale the building and go through each floor. But, hopefully if you're somebody who is good with your money, can save 5, 10 grand per month, it'll get you up to that second and third floor a lot faster. Certainly like, if I would have done it again, I maybe wouldn't have bought a fifth, sixth, seventh rental. I would have gone right into syndications and private placements. And but that's the whole idea is like, find the blueprint and then try and emulate it. But what I would kind of urge people is like figure out where you are first. Based on where you're at, that's what you should follow. So like, I mean, I'm not 7 feet tall. I'm not gonna follow what's in the Michael Jordan book. That doesn't apply to me, right? Same thing
Mhm.
with money. if you're a million, if you don't have $100,000, infinite banking's not for you. That's a waste of your time. But also the same way, if you've got $5 million, then rental properties just are not going to be scalable for you, and high liability in terms of legal liabilities.
No, totally. So if you had to like advise somebody on like what you're on the one thing they need to understand about cash flow, what would that be?
What about cash flow?
Just like how cash flow works, because you know like a lot of people like they think they know how cash flow works, but they don't like if everybody knew that everybody would be rich, you know?
I mean, you're making investments, it can cash flow and it can't. It doesn't need to. I mean, no different than buying stocks, buy low, sell high. You're not cash flowing in that time. But I think the nice thing and what attracts people to real estate is you can get into an asset that, you're renting out units and covering your monthly expenses in that interim. So it kind of makes it's kind of in a way kind of like a dividend stock,
Hmm.
right? You're in it for the long-term appreciation that you'll sell, but in the hold period, you're making some cash flow along the way. So that's kind of the beauty of cash flow. But what I've kind of learned is that very wealthy people, they don't really care about cash flow because they got enough money, right? They got cash flow coming from other investments. So that it's not per se what they're looking for. And they're looking more for long-term equity growth and net worth stabilization on the long term. So I think there's at least what I've learned the last few years is that there's a little bit disconnect. People, we all talk about the allure of passive cash flow, right? And that's great. I mean, that's what I was very focused at initially when I wanted to quit my day job and replace my salary, my W-2 salary as an engineer. But you can get there a couple ways. You can get there with cash flow, or you can get there with pure appreciation. But there's a lot of investments that do a little bit of both. And you have to build your portfolio with dozens and dozens and dozens of different holdings out there.
No, I mean you're right about that. And I do want the audience to definitely take a look at your books, like the Wealth Elevator, and also your other book about simple cash flow, so that they can get a better understanding about how money works and how they can also attain success.
Yeah,
And
yeah. So yeah, check out my book on Amazon, The Wealth Elevator. I've got a podcast, also called The Wealth Elevator. But yeah, thanks for having me on, Cosmos. It was good to
yes,
talk to y'all.
Lane, how would somebody connect with you and get to know more about your work and everything else that you're doing, including your podcast?
Podcast, you can go on iTunes, Google Play. You can just type in The Wealth Elevator. And then if you go on Amazon, you can go and type in The Wealth Elevator. It'll be sure to come up.
Lane, I'm so grateful that you took the time to come on this podcast and share your wisdom, and I really appreciate it. And I definitely hope that you come on the show at a later time.
Yeah, thanks for having me. Aloha, everybody.
Thank you, Lane. And I
Yeah.
want to conclude this episode by letting my fellow extraordinary Americans know that, hey, look, there's an extraordinary within each and every one of us. It's our duty to awaken it and unleash it. Until next time, bye for now. Hey everyone, thank you for watching Exploring America. If you like what you see, please do subscribe to our podcast and share it with others. Remember that the best investment that you can make in your lifetime is in your own financial education, for it is knowledge that truly sets us free. Also, remember that inflation is diluting your purchasing power, which in turn increases financial bondage. The practical thing to do is to protect the loss of your purchasing power and invest in precious metals or the right cryptocurrencies. Lastly, never forget that you are an extraordinary American. We'll see you in the next episode. Bye for now.